What's going on, guys? Gonna Invest here today, and I'm gonna help show you guys how you can time the markets and get an optimal return on your investment. Alright, before we get started with the video, I want you to take everything you think you know about economics and market behavior and toss it out the window. Instead, replace it with supply and demand and fear and greed, respectively. With that being said, let's begin. Timing the markets beats timing the market. This is a popular quote among the investing community by Warren Buffett. This is true for the average person. However, you're not average. And tossing your money at the market at whatever price for whatever stock is laughable. Let me explain. Looking at the dot-com bubble from 2000, if you invested at the worst possible time and held until December 2017, you would have made a return of about 40% in a little under 2 decades. Congratulations. Now, if you implemented good practice for once in your goddamn life and bought at the highest point in this box, you would have made over triple the amount in about 10% less time. The first phase is accumulation. This takes place after the market has bottomed. While professionals figure out that the worst is over, the market has been stable for a while and is beginning to edge higher. Buying pressure is added by innovators and early birds as they begin to buy, adding upward momentum, shifting market settlement from bearish to neutral. The early majority who keep up with the markets begin to buy in despite media intervention of weakening employment and increasing layoffs. This includes technicians who notice higher highs and higher lows, confirming the trend. As this phase matures, more and more people begin to buy into the markets, changing market settlement from neutral to bullish. This is known as the markup phase. As this phase comes to an end, more and more people begin to buy in, price begins to increase substantially, and the greater fool theory prevails. Greed begins to replace fear, valuations climb higher, well beyond historical norms. As the late majority are buying, the early few are selling, the cycle nears its end once prices make one last final push known as a selling climax. This is when the largest gains happen in the shortest amount of time. In the distribution phase, sellers begin to take control as market settlement shifts from bullish to neutral.
We're all gonna be rich!
Broke even!
Price can stay locked into a trading range for a short period in a desperate attempt to retest resistance, but commonly form reversal patterns, such as triple tops or head and shoulders. Distribution phase is a time ripe with emotions, valuations are absurd, and the over time market settlement begins to slowly change unless affected by a catalyst such as catastrophic news, which could accelerate the process. The final phase is the most painful for those who still onto positions.
That's good satire.
Markdown phase consists of market settlement changing from neutral to bullish, as many stubbornly hold on to false hopes of their positions being restored, until they lose all hope at around a 50% depreciable loss and sell their positions, which is unfortunately a buy signal for value investors, professionals, and contrarians to begin the accumulation phase, buying extremely undervalued assets at an appreciable discount, ready to enjoy the next markup phase. Present in every market, much like the circle of life in organisms or the water cycle, this is a process that is repeated thoroughly throughout history and will continue as such.